Let's go. Let's go. That's what I got for you today. We're going to be talking about HP stock. Reported earnings, obviously just not too long ago, as we're talking about after hours. We're on the ball today. You can't blame me. We're up 5.6% after hours with HP. So we'll look into these earnings and see what's the reasoning for it. So definitely one I'm somewhat excited about. It's not a massive position for me, right? We're talking about right around 15 shares, so nothing super crazy. But again, it's a position that I've always been a pretty big fan of, and I've been holding through, and I think it's been paying out now, I'll tell you that. So if you look at these earnings, HP, quarter four non-GAAP EPS of 62 cents, which is a beat by 10 cents, and a GAAP EPS of 49 cents, which is a beat by 2 cents. Good to see that. Beats on both of those aspects. I didn't know necessarily what to think about that, but pretty good. And revenue of $15.26 billion is down 1% on the year, but beats by $540 million. That's a massive beat. If you're talking about a revenue perspective for this, that's a really big beat because they were expected to decline 5%. They only saw a 1% decline in terms of overall total sales, and I think that's really good. I think it's a really good number for them. I think it's a very promising number as well. It's a really, really good beat. Really good beat. And for a guidance perspective, they're expecting for Q1 a GAAP diluted net EPS to be in the range of 58 cents to 64 cents, which is, not too bad. It's where they landed here. And a non-GAAP diluted EPS to be 64 to 70 cents versus a 57-cent consensus. But from a GAAP perspective, pretty massive. I'm expecting 58 cents to 64 cents compared to the 49 cents they put up this quarter. It is a really good number, potentially, if they hit that guidance. What I think is really driving this stock, let's be fair, better than expected numbers is good. But I also see a 10% increase in the dividend. It's pretty massive. And that's, frankly, and I'll still consider it, I wish I would have stocked up on a little bit more of this company, right? You're talking about a 19-cent dividend. It's pretty good. And I wish I had definitely, when I said to buy more of the stock, I wish I had done it because that's a big increase. 10% increase is really good. Forward yield now at 3.5. Very good yield for this company too, and that's really why I held the position all this time, is really just the consistent dividend, and they're still gonna, even through pandemic, consistent dividend, and they've increased it. That's how you know the company's pretty set out on paying this dividend, and that's what I think is really good news. It's gonna get a lot of value investors back in it. Looking at the press release itself, both for the full year and the fourth quarter, we're gonna see for the full year. EPS of $2 above the previously outlooked $1.83 to $1.87. This quarter helped quite a bit with that. Pretty good to see that. Non-GAAP EPS 228 is above the 216 to 220 expected. Net revenue is overall down 3.6% from the prior year. Expect to be closer to 5% down, so good quarter. Really helped them on that aspect. They returned $4.1 billion to shareholders through share repurchases and dividends this year as well. As far as the fourth quarter is concerned, a 49-cent GAAP EPS outlook compared to an expected, a 49-cent number actually, compared to a 32 to 36-cent outlook is really good. It's really good. Revenue only down 1% from the prior year. Expecting down 5%, so that's pretty good too. I can't say I'm not upset at all. HP also announced dividend increase of 10%, as you saw. I like to see that. I really do. Now again, you can bring up a concern as far as decrease in sales by 3.6% and what that could mean. I get necessarily what you're talking about there as far as potential concerns. I could see it. I really could. But overall, most numbers here for this company remained relatively unchanged. Really consistent company. And again, I'm more of future looking for this company, and I think 3D printing could be really big for them. But even if they don't have 3D printing, I think it's just a very good, consistent dividend-paying stock that'll get you a decent return on your investment. So that's really a big portion of that for me. As far as asset management, we'll look at the balance sheet too, because we like to look at the balance sheet. No doubt. Personal systems net revenue was $10.4 billion, which is flat year over year, which is good. Again, now it's not a decrease in personal systems. With 5.1% operating margin, consumer net revenue increased 24%, and commercial net revenue decreased 12%. Not a shocker at all. The good news is the consumer revenue, right? Commercial, you get why, because a lot of these businesses really weren't going to be purchasing new equipment. They don't have the money to. A lot of these companies, especially small businesses, with everything going on, especially new rounds of shutdowns, they don't have the money to really purchase new upgrades. So therefore, your commercial net revenue drops. Total units were up 7% with notebooks up 25% and desktops down 31%. Again, desktops are leaning into more commercial. Notebooks really big because of online schooling right now, so you've seen a lot of increase in terms of that. Printing net revenue was down 3% year over year with 14.8% operating margin. Hardware sales were up 14% with consumer up 18 and commercial down 10. Again, same exact thing there. Supplies net revenue was down 1%. Nothing crazy. That's just talking about really ink, and that just balances out between commercial and consumer use, really. So nothing too crazy. We saw Outlook already. We already took a look at that. Do want to look at this balance sheet because I think it's important too. Company a little bit of decline in revenue. We like to see the balance sheet if they can support a decline in revenue. Even though net income didn't see much of a decrease at all. But let's take a look. They give me a full year-over-year comparison, which I do like. So total current assets sitting right now at $20.6 billion compared to $20.1 billion a year ago. Total assets in general of 34.6 compares to 33.4 of a year ago. So an increase of 1.2 around there. Not bad. We do take a look, obviously, in terms of total other liabilities. Total current liabilities, I should say, of 26.2 compared to 25.2. Don't like to see an increase in liabilities. And long-term debts on increase as well. And so did other non-current liabilities as well. So you actually see a stockholder deficit developing on this company. $2.2 billion compared to $1.1 billion. It's doubled year over year. Again, it's not a massive doubling necessarily, but $1 billion is obviously a lot for me. But I think one thing you can notice, if this is a company posting a 10% increase in dividend, I think the management team's at least confident in this aspect, that this stockholder deficit won't necessarily stay. And that's why I haven't obviously developed a really big position like I wanted to. And I think there's some concern with the deficit there because you talk about dividend security. With a deficit like that, it's not necessarily the most secure thing. But with a recent raise, I think you can feel relatively confident with it. As far as share valuation, again, I've always thought this company's pretty cheaply valued. Even now it's close to 23. Brings the P ratio closer to a 15 range, which I think is still pretty fair value. I don't think the company warrants any sort of 30 PE ratio, but I think it should hover around a little bit less than 20 range, 18 to 20. I think is a fair PE for this company. Not really a company that's blowing you out of the water, but pretty consistent. I think it deserves to be in the middle ground of the market, which right now the middle ground of the market is closer to 30. But in a normal market condition, typically you're going to be sitting around 18 to 20% for a normal PE ratio, and that's where I think HP should be sitting. I don't know if there's going to be current, short-term capital appreciation besides obviously what you see after these quarterly results, so I can't necessarily say you're going to expect that, but I do think long-term you're fine with it because of a 3.5% yield is pretty good for you, and that's even at current valuation. So if the valuation goes down, your yield on cost goes up, so that's one thing you need to consider. or sorry, I should say the yield goes up necessarily. Your yield on cost increases if the stock increases more. So it just all depends what you'd like to see. I'm not necessarily going to be adding more shares. Again, with dividends, I will be reinvesting those right away. Nothing too crazy because, well, I mean, not much to say there. But obviously, whenever this gets paid out on January 6th, I'll just have it reinvested for whatever, $2 or something that it equates to for me. It's nothing crazy, but, I'm not too upset with it. Overall, hope you had a great time with this video and you have a good one.